Crypto ETF Floodgates open with SEC listing standards, but price impact may be uneven. The regulator's move sets the stage for a wave of new crypto products coming to market, but that alone won't drive demand, analysts cautioned. The U.S. Securities and Exchange Commission, SEC, has cleared a path for a flood of new crypto exchange-traded products to hit the market, a move analysts say could reshape how money flows into digital assets. On Wednesday, the agency approved generic listing standards for commodity-based trust shares across regulated exchanges Nasdaq, Cboe BZX, and NYSE Arca. Read more. SEC makes spot crypto ETF listing process easier, approves Grayscale's large-cap crypto fund. The new rules remove the need for each crypto ETP to undergo its own individual rule filing under Section 19B of the Exchange Act. Instead, an offering whose underlying assets satisfy certain objective eligibility tests, for example, if the crypto trades on a market that is a member of the Intermarket Surveillance Group, ISG, or if the underlying assets futures contract is listed on a CFTC-regulated designated contract market for at least 6 months, can be listed using these generic standards. The regulatory shift marks a watershed for the crypto industry, removing much of the procedural drag that has historically slowed getting new crypto products to the market, analysts said. The crypto ETF floodgates are about to open, said Nate Geraci, a well-followed ETF analyst and president of Novideo's Wealth Management. Expect an absolute deluge of new filings and launches, he said. You may not like it, but crypto is going mainstream via the ETF wrapper. Matt Hogan, Chief Investment Officer of digital asset management firm and ETF issuer Bitwise, said the SEC's move is a coming-of-age moment for crypto. It's a signal that we've reached the big leagues, he wrote. But it's also just the beginning. History backs up predictions that the number of new crypto ETF launches will accelerate under the new regime. When the SEC approved generic listing standards for bond and stock-based products in 2019, the number of ETFs launches more than tripled in a year, rising to 370 from 117 the year before, Hogan pointed out. Hogan cautioned against assuming new crypto ETPs will automatically drive large inflows. The mere existence of a crypto ETP does not guarantee significant inflows, he wrote. You need fundamental interest in the underlying asset. Take, for example, the slow start of spot Ether ETH ETFs. They only began gathering meaningful inflows nearly a year after launch once stablecoin activity and, by extension, Ethereum's investment narrative picked up, Hogan wrote. By contrast, products tied to smaller cap assets with less tangible use cases may struggle to attract capital absent renewed fundamentals, he added. Still, he argued that ETPs dramatically lower the barrier for traditional investors, making it far easier for institutional and retail allocators to pivot into crypto once sentiment turns. They also help demystify cryptocurrencies for mainstream audiences when names like Avalanche AVAX $33.95 and Chainlink Link $23.46 appear in brokerage accounts. Hogan said, what we are seeing now are underlying assets further down the value curve being rolled into these wrappers and strategies. Paul Howard, senior director of Wincent, told CoinDesk in a note. For institutions that cannot own spot crypto directly, these vehicles provide a wrapper and move liquidity into the ecosystem. The tokens most likely benefiting from this are large-cap altcoins. Dogecoin Doge $0.2657, XRP $3.0000, Solana SOL $236.98, Sway SUI $3.6655. Aptos APT $4.5776 and others are now ushering in the next wave of products, as investors look for opportunities and applications outside of Bitcoin BTC $115,766.91 and ETH, Howard said.